This will be everything that you will need to know in order to complete the master budget project. First, we're going to go through some slides on budget theory, and I just want you to read these, and then we will go through the steps to prepare the master budget. As we go through the pages on budget theory, I will thumb through the slides, but you should stop and pause them in order to read them. Now, let's go through the steps of what it will take to prepare a master budget. The master budget consists of a number of separate but interdependent budgets that formally lay out a company's sales, production, and financial goals. The master budget culminates in a cash budget, a budgeted income statement, and a budgeted balance sheet. Everything starts with the sales budget. You need to know what you're going to be able to sell, and from that you will be able to put together the selling and administrative and expense budget. And more importantly, from the sales budget you'll be able to put together your production budget, and from that the ending inventory budget. And from the production budget you will be able to put together everything that you will need by way of direct materials, what you will need by way of direct labor, and what you will need for manufacturing overhead. All of these, direct materials, direct labor, and manufacturing overhead, as well as the selling and administrative budget, will all feed, as well as the sales budget, will all feed into the cash budget, which is how much money you are going to have on hand, how much money you will be spending. All of that will lead also into the budgeted income statement and the budgeted balance sheet. Preparing the sales budget. The first step in the budget process is the preparation of the sales budget. This is a detailed schedule showing the expected sales for the budget period. An accurate sales budget is the key to the entire budgeting process. All other parts of the master budget depend upon the sales budget being accurate. If it is inaccurate, the rest of the budget will be so as well. It's based upon the company's sales forecast, which you will get from the marketing department. The sales budget influences the variable portion. Now remember, this is tied directly and indexed upon how much volume you have or how much sales you have, so that will affect the variable portion of the selling and administrative budget, and also feeds into the production budget, which defines how many units will be needed to be produced during the budget period. The production budget in turn is used to determine direct materials, direct labor, and manufacturing overhead. And once these have been prepared, it can prepare the ending finished goods inventory budget. So these will be prepared first before you go back to the ending inventory budget. The master budget concludes with the preparation of the cash budget, the budgeted income statement, and the budgeted balance sheet. Information from the sales budget, the selling and the admin expense budget, and the manufacturing cost budgets, direct materials, direct labor, and manufacturing overhead, all influence the preparation of the cash budget. The cash budget is a detailed plan showing how cash resources will be acquired and used. The budgeted income statement provides an estimate of net income for the budgeted period and relies on information from the sales budget, ending finished goods inventory budget, the selling and admin budget, and the cash budget. The final schedule of the master budget is the balance sheet, which estimates the company's assets, liabilities, and stockholders' equity at the end of a budget period. Print out these next 3 pages, as we'll be referring to these continuously as we prepare the individual components of the master budget for Hampton Freeze, which is our example. The beginning of the budget period starts with the ending balances from the financial statements. Here we have the balance sheet as of December 31st, 2013. We will be preparing a budget for 2014, but we need the ending balances from 2013 in order to do so. For example, the beginning accounts receivable balance in 2014 is $90,000, and it is on the schedule of expected cash collections as well as the beginning cash budget of, forgive me. For example, the beginning accounts receivable balance of $90,000 is on the schedule of expected cash collections as well as the beginning cash balance of $42,500 on the cash budget. Many of these beginning balances will be used in the individual components of the master budget. This is the budget assumption sheet. This talks about what they're expecting to sell in each individual quarter. How many, the selling price per case is $20. The percentage of sales when they sell something, everything's going to be sold through accounts receivable, so they're expecting to collect 70% in the first quarter of sales, and the subsequent quarter of sales, they're expecting to collect the remaining 30%. The percentage of next quarter sales in the ending finished goods inventory, they're expecting to have 20% on hand, and we'll see that when we go through that schedule. The direct materials budget, we will need to budget for 15 pounds of sugar per case. These Hampton Freeze makes popsicles. The cost a pound per sugar they're expecting is 20 cents. The percentage of next quarter's production needs in ending inventory is 10%. When they purchase these direct materials, they're expecting to pay 50% in the quarter in which they purchase it and the other 50% in the subsequent quarter. On the direct labor budget, they're expecting 0.4 hours will be needed for every case of popsicles they make, and they're paying their people $15 an hour. The variable manufacturing overhead per direct labor hour, we're going to use direct labor hour in order to apply manufacturing overhead, and that's going to be $4 per case. There's going to be fixed manufacturing overhead per quarter of $60,600, of which there's depreciation of $15,000. The variable selling and administrative expenses per case is $1.80. And these are the fixed selling and administrative expenses per quarter: advertising, executive salaries, insurance, property tax, and again, depreciation. That's going to be a component of it. The minimum cash balance the company wants to have on hand is $30,000. They're going to make equipment purchases in quarter 1, quarter 2, quarter 3, and quarter 4 of these respective amounts. They're expecting every quarter to pay $80,000 in dividends. We'll look at this when we come back, and maybe $20,000 per quarter. We'll look at that when we get to that point. And then the simple interest per quarter is 3%, but actually you're going to apply it at 12% per annum. Other budget assumptions. Let me give you a chance to read these. So this is how the budgeting assumptions tie together. So let's start with the sales budget. For the year, Hampton Freeze expects to sell 100,000 cases of popsicle at a price of $20 per case for a total budgeted sales of $2 million. So this is $10,000 in the first quarter, $30,000 in the second quarter, $40,000 in the third quarter, and $20,000 in the fourth quarter. They're selling them at $20 per case, and so the total sales, 10,000 times $20, 200,000, adding up each one of the quarters up to 2 million rather. The budgeted unit sales for each, we see that. The Schedule 1 shows also that the company expects to collect cash in the amount of $1,970,000. Well, why isn't that $2 million? Well, that's because they're expecting to collect 70% in the quarter in which they make the sales and 30% in the subsequent quarter. And so they're expecting to make all of their sales through accounts receivable. So we see that the accounts receivable balance of $90,000 is collected in the first quarter, comes from the beginning balance sheet. So we referred to that when we went to the beginning balance sheet. So $90,000 here. Then 70% of $200,000 in the first quarter is $140,000, and then the remaining quarter, the second quarter, they're expecting to collect the additional $30,000 or $60,000. The same pattern will repeat for quarter two. 70% of $600,000 is $420,000, etc. All of the cash collections rely on the estimated cash collection percentages from the budget assumptions. And then we just went through how that works together, and that's the text on that. So now we see, based upon the cash collections, they're expecting to collect $1,970,000, although their sales will be $2 million. The additional $30,000 they will be collecting in the first quarter of 2015. Next, we have to prepare the production budget based upon what we're expecting to sell. That's prepared after the sales budget. It lists the number of units that must be produced to satisfy the sales needs and to provide for the desired ending finished goods inventory. Again, we'll get that from the budget assumptions. This is how it all ties together. The budget requirements are influenced by the desired level of ending finished goods inventory. Excessive inventories tie up funds and create storage problems, and insufficient inventories can lead to lost sales or last-minute high-cost production efforts. This is Schedule 2, the production budget. It contains the budgeted production for Hampton Freeze. The desired ending finished good inventory for the first quarter is 6,000 cases. Now let's see how that's going to be computed. All right, so we're expecting to sell 10,000 cases. Now we want to have 20% of the next upcoming quarter's production. We want to have those desired ending units of ending finished goods, 20% of this 30,000 on hand. So in addition to the budgeted unit sales of knowing we have to produce 10,000 cases, we also want to have enough direct materials on hand for 6,000 cases. So the total needs for this quarter will be 16,000 cases. However, there were some units of beginning finished goods inventory from the beginning balance sheet of 2,000. So they had 2,000 cases on hand. So the required production for this quarter will be 14,000. Now, let's see how the pattern will repeat itself. We know in quarter two we want to produce 30,000, but we need to have 2% of quarter three's budget on, production on hand. So we'll need to produce direct materials enough to produce 8,000 cases on hand. So that's 38,000. But we had desired ending finished goods inventory from the prior quarter, quarter one, of 6,000. So we have 6,000 on hand. So we're going to subtract that, and that means that we only have to produce the 32,000. Obviously, this is budget planning at the beginning of the year, so they're expecting to have this on hand. This could change during the year, but this is the pattern. Now watch what's happening here at the end of the year when we're talking about what's on hand. Pay particular attention to the year column to the right of the production budget. In some cases, the budgeted sales, total needs, and required productions, the amount listed for the year is the sum of the quarterly amounts. See, this is the sum of the quarterly amounts. This, however, is based upon the desired ending finished goods inventory. Because it's balance sheet related, it's going to be one particular number. So it's going to be 3,000 as opposed to adding each one of these up. Now we're going to add up total needs for the whole year of 103,000. But because this was the less units at the beginning finished goods inventory, we're going to bring this 2,000 around to show that the 2,000 was on hand. So this will show us how much we have to produce for the entire year. This 2,000 and this 3,000 are balance sheet items. These represent the entire needs for the entire year. Next, we want to produce the direct materials budget. The direct materials budget is prepared after the production budget requirements have been computed. This details the raw material that must be purchased to fulfill the production budget and to provide for adequate inventories. The first line of this budget contains the required production for each quarter from Schedule 2. So you've already gotten all of this together from Schedule 2. So this all came from Schedule 2. The second line of the direct materials budget recognizes that 15 pounds of sugar, the budgeting assumptions, are required to make 1 case of the popsicles. Okay, so 15 pounds is going to be needed for each case. So the raw materials needed to meet production is going to be the 14,000 cases multiplied by the 15 pounds you need per case, and so the total raw materials needed will be 210,000. In the third line of the budget, the required production of, okay, we just said that. Okay, so now we know where the 210 came from. The fourth line shows the desired ending units of raw materials inventory. For the first quarter, this amount is computed by multiplying the raw materials needed to meet production in the second quarter of 480 pounds by the desired ending inventory percentage of 10% from the budgeting assumptions. All right, so we know we need 210, but we want 10% on hand for the upcoming quarter. So this 480,000, we need 48,000 pounds of sugar on hand. So this is our total raw materials needs. So the desired ending raw materials of 48,000 pounds is added to the 210 pounds to provide the total units of raw materials needed of 2,508 pounds. However, because the company already has 21,000 pounds of sugar at the beginning inventory, right? So this is the beginning inventory. Only 237 pounds of sugar are needed to be purchased in the first quarter. So we only need to purchase 237. Because the budgeted cost of raw materials per pound is 20 cents, the cost of raw materials to be purchased in the first quarter is $47,400. For the entire year, the company plans to purchase $303,300 of raw materials. So that's adding up each one of these quarters to $303,300. Okay? And because, again, beginning raw materials inventory is a balance sheet item, this is going to come around and be part of when we look at it for the year, the beginning balance that was on hand. Schedule 3 also shows the company's expected cash disbursements for the materials purchased for 2014. Now let's see how this is computed. We had a beginning balance from the beginning balance sheet from the December 31st, 2013 of $25,800, which was an accounts payable balance on hand. Now again, from the budget assumptions, we're going to see that we're expecting to pay 50% of this $47,400 in the first quarter and the other 50% in the second quarter. So this is the beginning. This is for this present quarter. So now total cash disbursements for this quarter is going to be $49,500. To this, we're going to add for the second quarter the other 50% of the $47,400. Then the second quarter purchases is going to be 50% of $97,200. It's going to be $48,600. And so the process will be completed from quarter to quarter, and then each one of these will be added across, and it'll show total cash disbursements for materials for the entire year of $301,200. The direct labor budget, Schedule 4. The direct labor budget shows the direct labor hours required to satisfy the production budget. By knowing in advance how much labor time will be needed throughout the budget year, the company develops plans to adjust the labor force as the situation requires. Companies that neglect budgeting the budgeting process run the risk of facing labor shortages or having to hire or lay off workers at awkward times. Erratic labor policies lead to insecurity, low morale, and inefficiency. The first line in the direct labor budget consists of the required production for each quarter, which is taken directly from the production budget in Schedule 2. So we can see the required production in cases from Schedule 2, each one of the quarters, what we're expecting to produce in each quarter. Now, I'm just going to paraphrase or summarize what this next paragraph says. The direct labor hours per case, we need 0.4 of an hour, 0.4 of an hour for each one of the cases. So the total direct labor hours needed will be $5,600 in quarter one, $12,800 in quarter two. So the pattern repeats itself. And we're paying our people $15 an hour, so we can see that we need to multiply the number of hours by how much we're going to be paying everybody per hour, and then we can see our total direct labor cost. So we can see that the direct labor budget is a lot less complicated to prepare than the other two previous schedules that we prepared. Next, we want to look at the manufacturing overhead budget. Now, this is going to be separated into variable and fixed costs. So the manufacturing overhead, although all costs of production other than direct materials and direct labor at Hampton Freeze, manufacturing overhead is separated into variable and fixed. From the budgeting assumptions, the variable component is $4, and we're going to apply that based upon how many direct labor hours we're expending. And the fixed component is $60,600 per quarter. Because the variable component of the manufacturing overhead depends on direct labor, the first line of the manufacturing overhead budget consists of the budgeted direct labor hours from Schedule 4. The budgeted direct labor hours in each quarter are multiplied by the variable rate to determine the variable component of the manufacturing overhead. So let me summarize what's in these next paragraphs by showing you what's in the schedule. So here are our direct labor hours per quarter. Our variable manufacturing overhead rate is $4 per direct labor hour. So our variable manufacturing overhead, we're going to be applying it at the rate based upon direct labor hours. So this is going to be our variable portion for manufacturing overhead for each individual quarter. And again, it's the hours times $4 per hour. To that, the variable portion, we're going to add the fixed portion. So then we are going to have our total manufacturing overhead. But since we also have to prepare a cash budget, we're going to have to subtract out depreciation in order to be able to isolate what will just be out of this $83,000, what will be the cash portion that we will actually be spending. So this depreciation is included in total manufacturing the overhead, or it's actually in the fixed manufacturing overhead. So we're going to separate it out, deduct it in order to come up with our cash disbursements. And so then what we're doing is we're looking at our total manufacturing overhead. So the bottom part of the schedule is the total manufacturing overhead, $404,000. We're going to look at our budgeted direct labor hours of 40,400, and then we're going to divide the 404,000 by 40,400 and come up with a predetermined overhead rate for the year of $10. And we'll need this when we are preparing some of the budget sheet items. So this is Schedule 5, the manufacturing overhead budget. Next, let's look at the ending finished goods inventory budget, Schedule 6. We need to prepare the other three manufacturing budgets before we can prepare this. After completing Schedules 1 through 5, all of the data needed to compute the unit product costs for the units produced during the budget year have been produced. This computation was needed for two reasons. First, to help determine cost of goods sold on the budgeted income statement, and second, to value ending inventories on the budgeted balance sheet. The cost of unsold items is computed as the ending finished goods inventory budget. The unit product cost computations are shown in Schedule 6. For Hampton Freeze, the per unit product cost is $13 per case of popsicles. That consists of $3 of direct materials, $6 of direct labors, and $4 of manufacturing overhead. The manufacturing overhead is applied to units at the rate of $10 per direct labor hour. The budgeting carrying cost of the ending inventory will be $39,000. So let's see how this works. And you will need this information also too when we're doing standard costs. So our standard quantity per case is 15 pounds of sugar, which is our direct material. It's 20 cents per pound. So for every case, it's going to cost us $3 in sugar. Our direct labor is 0.4 hours. We're paying everybody $15 per hour. So for each case we produce, we expect the direct labor associated with that to be $6. Our manufacturing overhead, we're going to be applying it based upon our direct labor hours. That's 0.4 hours. We computed earlier on the prior schedule, Schedule 5, that it was $10 per hour. So the 0.4 times 10 means it's going to be $4 manufacturing overhead is going to be associated with each case. So for each case of popsicles we produce, we expect our direct materials, direct labor, and manufacturing overhead to be all added up together $13. Now, from Schedule 2, we can see that we expected our ending finished goods inventory in cases to be 3,000 cases. We're going to apply the $13 per case, and we're going to see that our ending finished goods inventory in dollars, which will be a balance sheet item, will be the value that we'll put in the balance sheet, the budgeted balance sheet of $39,000. Next, let's look at the selling and administrative expense budget. This lists the budgeted expenses for areas other than manufacturing. In large organizations, this budget will be a compilation of many smaller individual budgets submitted by department heads and other persons responsible for selling and administrative expenses. Like the overhead budget, selling and admin will be divided into variable and fixed cost components. All right, so let's look at this. Since we need to do a variable portion, we're going to have to look at our budgeted unit sales in order to look at how to calculate our variable portion. So here is each one of the cases. Now this is from Schedule 1. This is just total cases. This isn't ending inventory and all of that sort of stuff because this is calculated separately. It's just based upon what they're expecting to sell. So this is selling and administration. So it's focused in on what they expected to sell. So 10,000 cases, 30,000, 40,000, 20,000 for the year, 100,000. Now the variable in selling and administrative per case is $1.80. So we're going to take 10,000 times $1.80, 18,000, and follow that same pattern. Now let's look at our fixed costs. We're just going to add in our fixed costs for each individual quarter. So there they are, adding them up for the total year. And this is our total fixed selling and administrative expenses. And then we're going to add that to our variable and come up with total selling and administrative expenses. We'll need that for our income statement. But again, we also have to take into consideration we want to prepare the cash budget, which is just going to be the cash disbursements. So we're going to have to subtract out the non-cash depreciation to know how much we're actually going to be spending, how much cash we will need in each one of these quarters. So let's go to preparing the cash budget in Schedule 8. The cash budget is composed of 4 major sections, and you may want to print out this page. The receipts section lists all cash inflows from sales, and we've already calculated that. The disbursement section, it summarizes all planned cash payments such as raw materials or direct materials, direct labor payments, we've already calculated that, our manufacturing overhead costs minus depreciation, selling and administrative minus depreciation, etc. In addition, other cash disbursements such as equipment purchases from our budget assumption sheet and dividends are listed. So how do we have our receipts section and our disbursement section? So now we have to calculate whether we're going to have a cash excess or a deficiency. So we're going to start with our beginning cash balance, which will be the beginning balance sheet. We're going to add up total cash receipts for the year. That's going to be our total cash available. Then we're going to subtract out all of our cash disbursements for the year, and then this will tell us whether we're going to have an excess or a deficiency of cash available. If a cash deficiency exists during any budget period, or if there's a cash excess during any budget period that is less than the minimum required cash balance, which from the budget assumptions, I believe it's $30,000. So even if there's a deficiency or if they have an excess, but it's less than the minimum required cash balance of $30,000, the company will need to borrow money. If there's a cash excess, the company then can repay the principal and the principal and interest if they did borrow any money when they begin to have a cash excess. Now we're going to talk about how we're going to finance any loans that we're going to need to incur in order to make certain that we have enough cash on hand. This section details the borrowing, principal, and interest payments projected to take place during the budget period. Assume for this chapter any borrowings are done on the first day of the borrowing period and repayments are on the last day of the final period. To calculate borrowings and interest payment, pay attention to the company's desired minimum cash balance and to the terms of the company's loan agreement with the bank. For example, Hampton's desired minimum cash balance, there you go, I remember correctly, $30,000 from the budgeting assumption. Assume that Hampton's loan agreement stipulates that it must borrow money in increments of $10,000 and that it must pay simple interest of 12% per annum or 3% per quarter. Again, that's from the budgeting sheet. So let's put this together. The cash budget should be broken down into time periods that are short enough to capture major fluctuations such as a quarter. You don't want to try and do this for the year. You want to know where your money is needed throughout the period. All right, so let's look at this. The beginning cash balance, it's going to be a budget statement item, a balance sheet item. So this was going to start from our beginning balance sheet. So we had $42,500 on hand at the beginning of the year. Then we looked at, from Schedule 1, how much we expect to collect from our customers during this quarter. This will give us the total cash available. Next, we have to look at our disbursements. So this is direct materials from Schedule 3. From Schedule 4, we'll have our direct labor, our manufacturing overhead. Again, this is less depreciation. So that's how much we're expecting to outlay in cash for manufacturing overhead. And then selling and administrative expenses, this is less depreciation. That's from Schedule 7. Now, from our budgeting assumptions, we know that $50,000 in equipment we want to purchase during the year, and then it looks like each quarter we want to pay $8,000 in dividends. So this will tell us our total cash disbursements that we need to make for the quarter. Now these were our collections. This is our disbursements. So we have a deficiency of $94,000 in the first quarter. Now we need to borrow $130,000. Now, I'll show you how to calculate that in a moment, so just bear with me. But just look at how the schedule is going to be prepared. Look at our ending cash balance. So we have a $94,000 deficit. We're going to borrow $130,000. So our ending cash balance will be $94,000 as a negative number plus $130,000 as a positive number, which will give us $36,000, and which we're going to carry to the top of the schedule here for the next quarter. And we'll follow and repeat this pattern through the second quarter. And so when we look at this for the year, because this is a balance sheet item, we are going to look at $42,500 as our beginning balance. And at the bottom here, because the ending cash balance will also be a balance sheet item, our ending balance we're going to carry over into this year column. Now, it looks like we won't have to borrow any money in the third quarter, and then in the fourth quarter we'll begin to pay the money back. But in the first quarter we're going to borrow $130,000, and in the second quarter $70,000. Now let me show you how that's calculated. In our first quarter, we had a $94,000 deficiency, but why do we want to borrow $130,000? Let's look at this. In the first quarter, the deficit of $94,000, Hampton wants to also maintain a minimum cash balance of $30,000. So the desired ending cash balance of $34,000, our deficiency of $94,000 means that we need $124,000 on hand. However, the bank requires loans to be made in increments of $10,000, so if it needs $124,000, we'll have to borrow $130,000. Next, we see there's a cash deficiency in the second quarter of $36,100. So how do we look at that? The desired ending cash balance, again, for each quarter is $30,000. Then the deficiency of cash available over disbursements, $36,100. That's from the previous schedule. So the minimum required borrowings will be $66,100, but again, we have to borrow in increments of $10,000, so we will need to borrow $70,000. So that's how it's calculated. In this quarter, we don't have to borrow any money, and then in the fourth quarter, we're going to pay it back. So in the third, fourth quarters, Hampton Freeze will have an excess of cash available over disbursements that is greater than $30,000, so it will not need to borrow money in these 2 quarters. Notice in the third quarter, Hampton has an excess cash balance of $165,650. $65,650. Yet the cash budget doesn't include any principal or interest repayments during the quarter. This occurs because in this chapter we'll always assume that the company will, as far as it's able, repay the loan plus accumulated interest on the last day of the financial period included in the cash budget. It's just an assumption for this chapter. Because Hampton Freeze has excess cash of $263,300 in the fourth quarter, on the last day of the fourth quarter, it will be able to repay the $200,000 loan it borrowed from the lender, which is the $130,000 plus the $70,000, and then it will also be able to pay back its interest. So the interest on how do we calculate the interest? The interest on the $130,000 borrowed at the beginning of the first quarter. So $130,000, and so that's 1% per month, or 12% per annum, and we're assuming that it's going to be outstanding for 12 months. Just bear with the way they're calculating this, okay? So that means it's $15,600 for the first quarter, and then the interest on the $70,000 that it borrowed at the beginning of the second quarter times 12% per annum, about 1% per month, times 9 months means that's $6,300, and so the total interest, which is simple interest, is $21,900. Finally, the ending cash balance for each period is computed by taking the excess deficiency of cash available over disbursements plus the total financing. So, for example, in the first quarter, the cash deficiency of $94,000 plus its total financing of $130,000 equals the ending cash balance of $36,000. The ending cash balance for each quarter then becomes the beginning cash balance for the next quarter, and I showed you that when we did the cash schedule. And also, again, notice that because it's a balance sheet item, in the year column you'll have your beginning cash balance and your ending cash balance based upon what's in the first quarter and the fourth quarter. And again, go back to that first cash balance schedule and you'll see how that's computed. So now we're on our second to last schedule, the budgeted income statement. This includes all the revenues and expenses, where they come from schedules 1 through 8. This is where our $2 million of sales comes from the sales budget. The cost of goods sold of $1,300,000 is computed in 2 steps, and it's from schedules 1 and 6. First, the cost of goods sold includes the 2,000 units of finished goods inventory from the beginning balance sheet. Okay, so we had 2,000 units of finished goods inventory that were already on hand in the beginning balance sheet, and that would have a total cost of $26,000. Why? 2,000 times $13 per case is 26,000. Second, it includes 98,000 units produced and sold multiplied by the $13 per unit from Schedule 6 for a total of 1,274,000. So we're going to add those two together, and combining these two, the total cost for the 100,000 units sold from Schedule 1 will be 1,300,000, which is the 26,000 from the beginning inventory, plus the 1,274,000 from selling the finished goods throughout the year. The selling and administrative expenses of 576,000 comes from the selling and administrative expenses budget, and finally the interest expense of 21,900 comes from the cash budget. All right, here are our sales, our cost of goods sold, our gross margin, minus our selling and administrative expenses, net operating income, minus our interest expense equals our net income. Now, finally, our budget sheet. Our balance sheet. Okay, so now we're going to have some things that are going to be information that's going to come from the beginning balance sheet and the data contained in the schedules. So this is how we're going to calculate this. Now, from our cash budget from Schedule 8, we know our ending cash balance was $41,400. 30% of the fourth quarter sales from Schedule 1, 400,000 times 30% equals 120,000. That's our accounts receivable. That will be what we're expecting to collect in 2015. So it will be 30%. Remember, we're collecting 70% in the fourth quarter, so 30% of the fourth quarter sales won't be collected until the upcoming year. So that's why it's the ending balance of accounts receivable for the upcoming year. For 2015, we're preparing this as of December 31st, 2014, so we need to look ahead to 2015. We know that we aren't going to collect that last 30% of the ones that we're going to sell in the fourth quarter of 2014 until 2015, so we have to include that as what we're expecting to collect in 2015. Next, from the direct materials budget, Schedule 3, we know that we are going to have raw materials on hand of 22,500 pounds at 20 cents per pound, and so that's going to equal the value of our raw materials ending inventory of 4,500. Then from the ending finished goods inventory budget, Schedule 6, we see that our finished goods inventory, this was a calculation that was very complicated, so it was its own schedule, and that's the 39,000. So you've already calculated all of that on Schedule 6. Now, the beginning balance sheet for E, for our land, nothing changed with reference to our land, so that's from the last year's ending balance sheet or this year's beginning balance sheet. Now, beginning balance sheet from 2014 or 2013's ending one, we had building and equipment, plus we had all of the disbursements, all of the things, the equipment we were expecting to purchase throughout the year from Schedule 8. So we started out with 700,000. We purchased an additional 130,000. So that's where we get the 830,000. And so that was how we calculated the change in buildings and equipment. Now, for accumulated depreciation, we had a beginning balance of 292,000 plus depreciation of 60,000 from the manufacturing overhead budget, Schedule 5. Plus we had depreciation expense of 40,000 from the selling and administrative expense budget from Schedule 8. So we're going to add 292,000 plus 60,000 plus 40,000. So our ending accumulated depreciation is going to be 392,000. Now let's look at how we're going to calculate accounts payable for our raw materials. This is 1/4 of the fourth quarter raw material purchases from Schedule 3. I'm sorry, 1/2. So remember, we're paying 50% and 50%. So 50% of the fourth quarter raw material purchases we're going to pay in 2015. We're preparing this as December 31st, 2014. So we're looking ahead to 2015. We know we haven't paid that, so we're going to have to pay that in 2015. So 1/2 of that will still be due. Next, our stockholders' equity, our common stock, just comes from the beginning balance sheet. Now we're looking at J, our retained earnings. So how are we going to calculate that? Well, we had our beginning balance as of our ending balance from last year, our beginning balance for this year, same thing, of $449,900 for retained earnings. Next, from our budgeted income statement, we see that we're going to add $102,100 in net income. So that's the $552,000. Next, we want to subtract out the dividends paid, and that's from Schedule 8. We know we were going to pay out $32,000 in dividends, and so our December 31st, 2014 ending balance in retained earnings will be $520,000. So this